We say risk management, risk uh, analysis. You know, for new traders, it's all about strategy. It's all about strategy. You know, I was at that point in my, trading career as well when I thought everything was all about strategy. But, guess what? I had a great strategy, came up with a great strategy that at least, have a high win rate, but I was finding it difficult keeping the money I was making, and I had to, go through that process over a long time before I finally discovered that the risk parameter has, a long, has a strong role to play in the entire, trading process. The risk management, the risk analysis. Risk management, it's not all about entirely about what you hear, risking 1% per time of your capital. Yes, you can risk 1% of your trading capital on per trade. So, which is very great, but the problem is, sticking to it and knowing what to do when you're in a drawdown or when you are in a winning trade. So, over the course of, let's say you take 8 or 10 trades in a row, and you lose, let's say, like 6 trades out of that 10 in a row. You see, your mind will be shifted into, thinking after you lose the first one, you could still maybe keep a low lot size, risking very small, and then you lose the second one, and your mind will be shifted to, okay, maybe on the third trade I will get it right, and then you decide to increase your risk, and then the losses come again, and you keep it up that way, and then more losses. And so when you do that, you're practically reinforcing failure. You shouldn't reinforce failure when you're in a losing streak. What you should do is double down on your risk, double down on the lot size. Let's say you're trading like 0.5, and then you're on a losing streak. You should double down at least to 0.25 or probably 0.2, and then to at least recover from those losses first. Put your account in a little profit before doubling your increasing your lot size. And so that's how the risk analysis, the risk management should work. When you trade it that way, believe me, you're not going to miss any trade. No opportunity would leave you. The market is always there, and opportunities come up every now and then, opportunities to make money. And so when you look at it with from that perspective, when you look at it from that angle, you have a long playtime in the market. When you have losses, you still have money to come back and try. And so let's take, for example, let me make this clear to you, this risk analysis. When we trade on this market, we're dealing with uncertainty, and we're dealing with probability. It's not certain, no matter how great a setup is, and no matter how you've back tested it, the future performance of that instrument does not, the past performance of that instrument does not guarantee the future performance. And so we are dealing with uncertainty. And so the move that you anticipate to the upside is not certain. It's a probability that it could go to the upside, or decide to continue going down. And so since we're dealing with uncertainty and probability, we would have to deal with it. You have to approach it from an angle, having the mindset that, okay, what if it loses? What if the losing trade? What impact would it have, on my account if I decide to risk this portion of my capital? You have to always, have that in mind. Don't, approach the market with the mindset that it has to be a winning trade. No, you have to come to the market with the mindset, what if it goes wrong? What will be the impact on my account? And so let's take, for example, if we have, let's say, 10 balls in a basket. You're dealing with probability. We have 10 balls in the market, and you are supposed to, out of that 10 balls, we have 6 defective balls and 4 non-defective balls. And so when you continue to pick from the basket, let's say you pick the first ball, it's a defective ball. You go again into the basket, pick another one, it's a defective ball. Now you have 4 defective balls and 4 non-defective balls left. So you go again, you pick another defective ball. You continue picking until you would see that you successfully pick 6 defective balls, and now you have 4 non-defective balls. So when you continue picking next, you pick 4 non-defective balls. So these 4 non-defective balls, will represent the winning trade, the trades you won out of 10 trades. And now, because you won 4 trades out of 4 trades after taking 10 trades, and you lost 6, now the risk reward ratio comes into play. If you're risking 1 to make 3 and you won 4, when you do the maths, you would see that you're still in profit. So 1 to make 3 and you won 4, and so you still have like 3 times 4, which is like 12. So at the end of the day, you broke even, you recovered from those 6 losses, and you're still in profit at the end of the day. So in trading, we're dealing with uncertainty and probability, and it ought to be treated that way, like a business. And so when you decide to risk your entire capital, 75% of your capital on a single trade, you need to be aware that it could go wrong, and the impact could be destructive on your account. So when you have that in mind, and you're not risking your entire portfolio on that particular trade, but what you have in that broker's account, then it's all good. But if you're risking your entire portfolio, you need to be rest assured that you're gambling, and anything can happen. And so for new traders, like I said earlier, it's all about strategy. But for traders that are becoming advanced, moving from intermediate to advanced, they know that they need more than just strategy. They need to build themselves psychologically and have a great risk parameter to be able to succeed on the long term in the market. And so I'll be dropping more content, psychological content, risk analysis for different account size as we go on trading, trying to get funded with one of these prop firms. And so subscribe to my channel and turn on the notification bell so you can be notified anytime I upload a video. And please, you could as well leave a comment in the comment section. You like, share the video. Thank you.